Click on the link and it takes you to the NASDAQ Advanced Decline. So there's the market with opportunity. If advancers beat decliners, we want to be bullish on the OEX or bullish on the QQQ. So then the question is, there's the opportunity. What's the right strategy? What's the right entry? What's the right exit? The strategy is to buy a front month at the money index option on the signal. So front month, what month would that be right now? December, exactly. Now what happens, remember that parabolic curve? I told you you wouldn't need to know the math, but you need to know the concept. That last 2 weeks is a death dive. So we cannot buy front month options in the last 2 weeks, especially if you buy a call and you hold it for 11 days because the trend is your friend. Well, you don't want to be in that period where you're getting the death dive, right? Because you'll have a friendly trend, but a very unfriendly time decay. So that's why basically sometime in the beginning of December, 2.5 weeks before the at the money options or the December options expire, we would start to the Januaries. Okay? If you're bullish, and let's just say on Monday we get a signal to buy a call. If you're bullish, you buy a call and you hold it. If on Tuesday you get another bullish signal, just hold on to your call. Don't add to it. Everybody follow that? So if that's the case, if advancers beat decliners, you buy a call. If it reverses course, where decliners beat advancers, what do you think you would do? Sell your call. There's your exit strategy. And then do what? Buy a put. There it is. Like I said, it's really simple. 2 numbers. So now we have our exit strategy. We know what strategy to buy. Buy an at-the-money front-month option. At the money, what does that mean? Remember that? What does that mean? Anybody want to take a shot? The strike, stock price closest to the strike price, or strike price closest to the stock price. So if the QQQ is right around 39 right now, so what would our strike price be? Actually, it's 39. Because the QQQ, those options are in $1 increments. Now, OEX is pretty interesting. They just started this with this expiration. The December options had them listed 10 points wide. So the OEX was at 559. A couple days ago it was at 565. So you either had to choose the 560 or the 570. Whichever was closest. So if it was 565.01, I'd choose the 570. And 564.99, I'd choose the 560. And if it's 565, then I flip a coin. But just choose whichever one's the closest. Everybody follow that? So now we've got just about everything we need. We've got the market with opportunity. It's either going to be the QQQ or the OEX. We got the strategy. If it's bullish, buy a call. If it's bearish, buy a put. Which put do we buy? The at-the-money front month. Unless it's 2.5 weeks before expiration, then we go to the subsequent month. So we got the strategy, and we have the exit strategy. And the only thing left to answer then is what's the right entry price? And we're going to make it real simple. At the market. Just real simple. Everybody follow that? And that's it. That is it. No more complicated than that. Now, how would this system have performed? If you turn to the very back page of your manual, the last 4 pages, I've got a detailed trade-by-trade track record for both versions for 2004. And let's just take a look at the OEX first. This is every single trade for 2004. Now this is going to look a little bit different than yours, and the reason is because I've got it updated. Remember I told you I updated everything through last night. So I've got this thing updated through last night. There were 96 trades. 34 of them were winners. So you can see there are more losers than there are winners. This is not a high probability system. Also, look at the number of trades. 96. This is not like you put it on and let it go for 3 months, right? This is the action. This is action, folks. The total dollar profit trading just one contract, though, just one contract is about $2,000. And one contract, like right here, the one contract was $580. Right here, the one contract was $1,260. So you're looking at around, you can see the average right up there. Yeah, it's right around $1,000. We figure, looking at past drawdowns that this system has had, to trade just one contract would require an account of around $9,000 or $10,000. Which, if you think about that, you start with $9,000, you invest $580, which means you've got $9,400. You start with $10,000, you get $600 invested, $9,400 sitting in cash. Everybody follow that? That's the OEX. It doesn't look that good, does it? I mean, it's a lot of effort. This is the QQQ. And you can see, here are the options right there. $65 for the put. To be on equal footing, I'm calculating the dollar profit trading 10 contracts, which would be $650 to do 10 of them. Look at the 97 trades, only 25 of them were winners. But look at the total dollar profit. It's $6,100. Now that's pretty darn good. This is using the advanced decline for the NASDAQ. The NASDAQ advanced decline. If one number is bigger than the other, you buy. If advancers bigger than decliners, buy a call. Decliners bigger than advancers, buy a put. And that's it. And so how can you have 25 winning trades out of 97 and end up with $6,000? And the answer is 25% loss. This is why you win. 115%, 328%, 71%, 176%. You see what's happening? You have these huge winners. That's why it makes money. It sort of just turns around, and then bam, you get the trend. It truly does become your friend, and you get these big winners. I'll take a question here in just a little bit. One thing I want to just state that you've got to, with respect to this system, the system is good. The question is it right for you? And this is a question that you have to answer. Because it's wonderful. It's a wonderful system. But what cannot happen is, oh man, I lost money. Oh, I lost money. Oh, it's just, or I've got 5 losers in a row. You know what? I give up. Boom, boom. 70% winner, 185% winner. And then you say, oh man, I am so excited. I got to do this again. And then what happens? I mean, basically you tread water for a while. Now, does that mean the system's bad? No. It just means you got to do every trade. And if you don't have the discipline to do every trade, then it's not for you. Does everybody follow that? That is critically important. The other thing is, if you ever go on vacation, you'll be on vacation right here, but you'll be sure, you know, it's like I'm going to follow every trade religiously until I go on vacation. And there you go. You'll have the 5 losers, and then it's like, okay, he's gone. The market now knows you've gone on vacation, and boom, boom. You'll just fabulous performance. So whenever anybody goes on vacation, be sure to call and let me know. No, I'm just kidding with you. Sometimes it feels that way, doesn't it, though? It's like, how did it know? I was just talking with a good friend of mine. We were shocked. I can't go into it. Never mind. I'll edit that part out. Now, where's that microphone, Terry? You had a question? Okay. There's a mute button there.
Thank you. I just wanted to verify, you had mentioned on the OEX, basically you ought to have about 10,000 committed to that strategy, one contract.
Right.
So
and
roughly 1,000 per contract. Figure.
Right.
Okay. Same thing on the triple key, you said 10 contracts?
Yeah, it'd be about a $10,000 account to trade 10.
Figure about 1,000 per trade.
Right.
Okay. And that takes care of those drawdowns like you're showing
Yes.
in those particular instances?
Yes.
Okay. Question I had was...
By the way, the drawdowns have not been anywhere close to that this year. But last year, the drawdowns were significant enough that you would have required that amount of money in your account to still
keep it going.
keep it going.
Okay.
But this year, all you got to do is look at those numbers, and the drawdowns have been insignificant this year. Okay, questions over here, and we'll go around the room. Yes?
Since consistency is key.
Yeah, it's on.
Since consistency is key to this strategy, what time of the day do you actually...
We look at it at the end of the day. We're looking at it between 3:55 and 4 o'clock p.m. Eastern Time and trying to implement it right there at or near the close. Now, from what I understand, the thing actually does work because customers have told me, not from me, not from any personal experience, but customers have told me that they have waited until the following morning and it's worked almost as good. So, but I don't know the details of that. Not like I know the details of this. Now you had a question over here. We're going to pass the mic over. Yes, sir.
My question is, since it's only successful about 40% of the time, have you looked at it the contrary way, that when advances are greater than declines, you would do just the opposite instead of buying a call?
I have not looked at it. I have
buy
not
a
looked
put?
at. Yeah, that's a good question. I have not looked at it that way, but I will bring up a graph that will answer that question. Right. Remember I said that this thing accurately predicts the direction 60% of the time? If I were to create what's called an equity curve of the direction, this sort of gets back to your comment about if you just traded a mutual fund, what would the performance be of the mutual fund? trading direction, like a bearish fund going short, a bullish fund going long. What if I was just trading a straight index product? And this is what the profit would be, trading a straight index product. You make money. If you're short and it goes down, you make money. If you're long and it goes up, you make money. If you're long and it goes down, you lose, and so on and so forth. How does it accurately accumulate directional prediction? And that's that. So the question, that answers the question. Is the loss attributed to predicting direction wrong, or the time value deterioration and the loss of the bid ask and the commissions? And the loss, it accurately predicts direction. Very, very much so. It accurately predicts direction. This is for the S&P 500. This is for the NASDAQ. So you can see this. If it was just predicting direction, and this would be, I'm going to go short the QQQ. I'm going to go short the QQQ, and when it's bearish, when decliners beat advancers, and long when it's bullish, and get 40 contracts, because that's the QQQ is 1/40th of the NASDAQ 100, and do 40 contracts. How would I be doing? And I'd have, starting at 0, the thing's up to $700, almost $780, or 780 points.